But let's straight away get to the big story of the day, and that's mutual funds have started releasing the results of the stress test, Surabhi.
Well, absolutely. And we have a full house to try and understand how we should interpret these stress test results and how, of course, investors should look at mid-cap and small-cap funds from here on. Well, we are expecting to get full industry-wide disclosures by the end of day today. Yes. From last night, a few of the mutual fund houses started disclosing the results of these stress tests, and we'll have more AMCs disclosing throughout the course of the day today. So we have experts here with us, product manufacturers, also someone who can help us with the analytics. Let me welcome on the show A. Balasubramaniam, MD and CEO at Aditya Birla Sun Life AMC, Radhika Gupta, MD and CEO at Edelweiss Asset Management, Swaroop Mohanty, Vice Chairman and CEO at Mirai Asset Investment Managers, and Kosta Belapurkar, Director of Fund Research at Morningstar. Thank you so much, lady and gentlemen. Thanks for joining in. So it's been, I think, a busy evening and night for a lot of us, maybe for a lot of you as well, I'm guessing. And the first set of results are out. So I want to, start by getting the panel's reaction to how investors should read that data. Because now we know that for any particular small cap fund or mid cap fund, it will take X number of days to liquidate that fund. In some cases, that X is high. In some funds, it's as high as, 20 days plus for 50% redemption. So should one be worried or not? And if not, then why not? Radhika, why don't you open the floor? Ladies first.
Thank you, Surabhi. So firstly, I think the fact that these disclosures are happening is a very good thing, because at least it's telling investors that you have to look at portfolio quality, you have to look at liquidity. And it is my belief that especially over the last 2-3 years, investors have become extremely return obsessed and they don't look at anything. And in markets like this, which have been raging bull markets, money is flowing in. If all you look at is returns, is a little, it's worrying. So I think the signaling here is that, look at the portfolio. I think SEBI's signaling is not that I'm doing anything. I'm not stopping flows. That's an individual's AMC's call. But I'm telling everyone to put out disclosures and please look at these disclosures. Now, from our point of view, I think liquidity, well before this disclosure, is actually something we have looked at these ratios internally for the longest time. In fact, we look at these ratios in our AMC without the 20% carve out for the most illiquid stocks. And I think investors have to do this in a slightly balanced way. So there is no right answer as to what you should see on that stress test. I mean, is 15 days too much to liquidate 25% of the portfolio, or is 20 days? These are hard things to put a thumb rule at. But hypothetically, if your fund is at the bottom of the industry in terms of liquidity characteristics, should that raise a red flag? Perhaps I think that should raise a red flag. So I think investors have to remember liquidity is important. Don't panic about it. The data doesn't look bad broadly. But if there are specific cases and funds you hold where the data looks extremely bad or bottom quartile, maybe it's worth thinking about it.
Okay, that's a really important point, and I want to bring Bala in on this as well. Bala, your reaction to this. Radhika is saying if in a particular fund, the number of days that it takes to liquidate, if you're right at the bottom of the industry in that particular category, then perhaps it could be cause of concern and should be cause of concern for investors. What would you say?
Well, we'll have to look at how it's being calculated. I think the number that has been given out by the industry with an assumption, if there is a 50% drawdown, and then you sell the securities that is there in a portfolio in a proportionate to your holding that you have. And the same way it's been calculated on a 20% drawdown. So it essentially means that the assumption that has been made to calculate the number is on a proportionate basis you will actually divest. And therefore, this number is an extreme case. I think this number should be seen as an extreme scenario, how the numbers will look like. Therefore, while the number is good to see, one should not pay attention. This is an extreme scenario. When the extreme scenario happens, once in a while the extreme scenario happens. Therefore, one must be knowing about these numbers that in a scenario which becomes worst in the industry, in terms of heavy redemptions comes in, therefore how it would look like. But in reality, if you also look at the other column, in addition to that, there's another column also has been given, which of course highlights about how your portfolio is spread across between the large cap, mid cap, small cap, and cash. So when the money manager takes a decision, he looks at actually portfolio constrictions. He also looks at the portfolio concentration. Is also given as part of one of the column, which is portfolio concentration, the top 5 stocks contributing to the overall portfolio concentration. And the same way, another column which is given, which is the investors' concentrations. All these factors has to be looked at in together. We cannot look at these numbers and only one stress number you take 80 days you can say is bad and 4 days is actually very good. While the number is actually on a standalone basis, you can come to that interpretation, but we have to just keep this in mind. Second, from investors' point of view, you have to ask this question: is he coming actually chasing the return and looking at for 3 months investment, 6 months investment, or he is looking at the portfolio construction, the basis which is coming for say 5 years or 10 years or 6 years kind of things. As long as the time horizon actually is there very clear in the mind of investors, these numbers should be only taken for the purpose of knowing and basis where I'm investing for the long term. As Radhika mentioned, it's not about stopping the inflows or something. What is most important actually having more information being given. In fact, I must mention that each of the mutual fund, including IISL mutual fund, have been tracking the number for all our portfolios within our IC meeting that we disclose it. We of course show the mirror to the money managers while considering the portfolio. Therefore, taking into account the risk that is involved, other than the risk which I mentioned about concentration, etc., the liquidation risk is always monitored. Now that is coming in the public domain, the difference actually what we monitor and what is coming in the public domain is actually the proportion versus the fund manager's choice of divesting. So therefore, that have to just keep in mind. My view is take these numbers, but don't react. Don't say, no, it is bad. Somebody is high number, therefore is bad. Somebody low number is therefore is very good. But ultimately, somebody who has taken a higher risk, I'm sure you would have written a higher return. At the same time, somebody who's going to higher return, not necessarily that you will be able to maintain the higher return forever. Therefore, that also one should keep in mind that while choosing these, while reading these numbers and choosing the funds.
Swaroop, the mutual fund industry has been conducting these stress tests internally for a while now, periodically. It's just the first time it's become public. So just to put that number, which is disclosed, into context, can you tell us for Mirae, for the Mirae's funds in small cap, what was the number of days it took earlier for you to liquidate 25% and 50%, and what is that number today now? So just to understand if the risk associated with it has gone up.
Bring me on your show, and we mutual fund guys normally start with a disclaimer. So my first disclaimer is at Mirae Asset, we don't have a small cap fund. And in the last 2 years, we've trying to justify why we don't have a small cap fund in practically every discussion we've been going to. And that's how large the return chasing has been in the market. Is like not having a small cap fund is like not being an MC in the market. That was our status. So our data is mostly restricted to the mid cap, where 50% I think is getting done in 10 days, and then 25% in 4 days, something like that. We just put it up on our website. So our data is mostly on the mid cap side. And then just to take this discussion forward, broadly, there is nothing that is coming out to investors which they don't already know, excepting that number of days. They already knew that the large caps were more liquid than mid caps than small caps. That is a reality which they knew before investing. If they did not, then they need to really recheck as to what their investment process is. That's a fact. Now, every fund, I can assure you, has its own process of liquidity management. This is much before the SEBI regulation has come out. Now, this is something which has just come out in a certain format that the regulator wants her to do. But I can assure you, whether it's Radhika or Bala or me, everybody would have their own way of liquidity management. Again, just putting out that number of days is not the right way of ascertaining every fund or putting it on one small podium. You have to bring in the skill of the back end of the fund management, the skill of the dealers, the skill of the entire fund management unit in managing that liquidity, which will differ from fund house to fund house. And that's where the skill comes in. So at this moment, just coming to a conclusion on the number will be the other wrong step that an investor would take, would be my submission.
So, Swaroop, I take your point, and I think that's what we've been trying to say in our analysis since morning as well, that don't only go by that number that it requires to liquidate the fund. We have to look at other aspects as well. But having said that, I mean, going back to what Radhika was saying, that if in terms of the liquidity profile, you are at the bottom of the tally, then perhaps that's something that cannot be entirely ignored. And let me add the other parameter that Bala was talking about, the portfolio concentration parameter, because now, I mean, at a glance, I don't know if this was happening earlier or not. I know I surely wasn't looking at fact sheets in such detail, but now it seems at a glance, we get to know that within a small cap fund or a mid cap fund, particularly I think this is important for small cap funds, how much is pure small cap and how much is large cap. Now, in the good days of the market, a small cap fund with 80% small cap exposure perhaps will do very well. But in adverse markets environments, the reverse may happen. I'm just saying may. So I want to ask this panel, how should investors look at this market cap disclosure that is also sort of is happening now? Radhika, let me come back to you on this.
Yeah, and this is one that's very important to us. So, I mean, our liquidity numbers are out, and of course, funds are very liquid because we've always been very careful about liquidity. Now, at least for us, the belief in small cap funds is that SEBI's rule is minimum 65% small cap, the balance is free. There you have an option to hold mid cap, you have an option to hold large cap, and you have an option to hold micro cap. We don't believe that a true to label small cap fund should be hiding in large caps. We just think that a small cap fund is largely meant to hold small caps, and the balance can be in mid caps that are smaller mid cap or micro caps that are larger mid cap. So you stick to the narrative of the fund. So true to label has been very important. So if you see our small cap fund, there will be no large cap exposure, and our liquidity numbers are, I think, 2 days for 25, 2 days for 25%, 3 days for 50% without large caps and cash. I think that stance differs from industry to industry, at least. And some people will take the point of view would be that saying, oh, you've done large caps, so you are more liquid, so that fund is safer. We have a different point of view. We think a mid-cap fund should largely be doing mid-cap. It should not need to hide in large caps. Liquidity should be built bottom up into the portfolio rather than throwing cash or large caps to add liquidity at the end.
Okay, very quickly, before we take the break and continue the discussion, Bala, just your quick thoughts, because we have to hit a break as well, and then we'll come back. But just purely in terms of this disclosure on concentration, now investors know that this is a small cap fund that has 70% small cap, or 65% or 80% small cap. Could that cause a flutter within the investor/distributor community?
I don't think so, Surabhi, for one simple reason that any amount that is coming in a small and mid cap is come one as part of the asset allocations. Second, if you want to actually generate significant alpha over a period of time compared to the broader market cap, which is Nifty or Sensex, you have to go down the market cap, and basically you have to choose your portfolio. And at the end of the day, as the company is small and able to grow actually much faster than the broader economic growth, then naturally the value unlocking coming from these companies will become large. That's why we have seen the last 30 years, many small companies have become mid-cap, many mid-cap companies become large cap. As they become large cap, the rate of growth definitely will be lower than the smaller mid-cap companies. Fundamentally, that's the way it works. So from investors' point of view, these numbers should be taken only for the purpose of knowing and information. And what is most important is actually that allocate when it does it has to look at actually a time period of say 5-7 years. Given the fact, just go back to memory, in the 2019, the entire mid-cap actually there was a complete massacre on the mid-cap companies. But the same set of companies, if you look at it today, they have been a multi-bagger in the last few years. So we have to go through the cycle. Therefore, investors have to understand this. Whatever we are doing as money managers, will of course walk the talk from way of having a discipline of investing about 68% in small cap, in the small cap portfolios. In the mid cap would be about say 68% in mid cap, and rest will be manage the liquidity through the allocation to large cap as well as the cash. That's the way the liquidity is managed. So therefore, again, come back to the same point, that number that is coming in is on the basis of proportionate basis if we sell. Nobody sells on the basis of proportionate. They always sell on the basis of what it can sell immediately, and then adjust the portfolio over a period of time, curate it over a period of say 1 or 2 months. Therefore, that's the process will always continue, which is historically followed by most of the money managers. Therefore, we must look at this as a longer term allocations, and these numbers should be taken as a part of the knowing purpose rather than reacting purpose.
Okay. Do stay on. We need to slip into a very short break. As we do that, we'll also listen in to Quant Mutual Fund, Sandeep Tandon, who we chatted with earlier today on the mutual fund stress test impact. Listen in, and we'll come back after this short break.
Our portfolio are fairly liquid, okay? So we talked about how we have moved gradually towards a large cap also. So we are nearly 30%, 28 to 30% is the number where we have large cap stock also in our mid and small cap portfolio. If you really look at what regulator is also trying to convey, they're not putting any restrictions. Basically they are trying to ask AMC that you should look at, even you should ask your investor what is their risk appetite, what is their investment horizon after mid and small which has rallied, okay? And they're talking about disclosing more data points that investors should aware of, okay, when they're participating or they're increasing the exposure in mid and small cap, or whether they like to switch to other schemes or they want to hold the scheme. So it's a part of a more transparency regulator is asking, and we are trying to give that data. So it's a step in the right direction. In fact, if you really look at lot of data points we actually have started giving in our annual monthly fact sheets also.
Welcome back. We're in conversation with A. Balasubramaniam, MD, CEO at Aditya Birla Sun Life AMC, Radhika Gupta, MD, CEO of Edelweiss Asset Management, Swaroop Mohanty, Vice Chairman, CEO, Mirai Asset Management, Investment and Managers, and Kaustubh Belapurkar, Director of Fund Research at Morningstar Investment Advisory, India. Thank you very much. Kaustubh, first question. Now, how would you analyze, what are your first thoughts on what we've heard so far from the results of the stress test and what we've heard from our panelists? Is there a cause for concern? You're in mute.
Yeah, sorry. Just putting things into perspective, hey, Rima, hi. So I think, these numbers and, through our conversations over the years with several asset managers that we've been covering strategies, I think we've had a good pulse on the numbers because that's something that we incorporate into analysis, thinking about liquidity of portfolios. So I don't think these numbers are extremely surprising to us, right? And maybe I'll just give some global context in terms of how some of these liquidity numbers stack up. So if I think about, say, a European small and mid cap, right? We ran this number for a $10 billion European small mid cap fund, and I think it took about 40 odd days to liquidate half the portfolio. The numbers look a lot better for a US small cap, but it's a much broader and deeper market. I think it took about 10 days to liquidate half the portfolio, right? So, but I think the most important thing, and what the panelists were talking about, right? These numbers they shouldn't be looked at in isolation. I think it's good that they're out there. It just makes people aware that, look, you have to look beyond the standard risk metrics, and there is something called a liquidity assessment of a portfolio, so it's good. But I think investors don't need to really dig too deep unless they see extreme outliers, in a particular category where one finds probably lying at, way couple of standard deviations away from the rest of the peer group. Then obviously that's something that you want to think about. But otherwise, I think, broadly these numbers don't look completely, out of any ballpark from what I've seen the current numbers, right? So I think that's one thing. The other thing which is a great, and I think that's an important perspective, is also think about the liability of the asset manager, right? Which is the spread of the investors. And I think that's also a disclosure that's been made, which is good. And again, if I put that into context, right, we have well spread out, retail investor money that's in these portfolios. So obviously, even when you run these stress tests, at 50%, that's a pretty aggressive number because, you wouldn't expect, so many retail investors to move out money, in a short period of time. Right? So I think that is the comforting factor, unlike certain global markets where you could have large institutional mandates which could own, significant portion of that fund, right? So I think that's probably, the positive side of this aspect that I think about it. So I think overall, it's good. This has come. And, I think to Bala's point, also that investors need to think more about allocations in their portfolio. So while you're trying to think about, is this fund liquid or not, I think the starting point for every investor should be about asset allocation, thinking, am I over-allocated to a particular category? And because all of this is out there, maybe it started that conversation for investors to maybe just rethink that, am I overexposed to a category like small caps where, obviously there's been a lot of run up in the markets. Do I need to take a step back, right? I mean, I think that's probably a really good play in terms of what can come out of this disclosures.
Absolutely. Kaustubh, very quickly, just one follow-up question. We're running short on time, and I want to take a closing comment with all our other panelists as well. But Kaustubh, now also help us understand how we should tie in the size of a fund with the number of days that it's taking to liquidate that portfolio. I think now we'll start seeing disclosures from the bigger fund houses as well. I mean, just in terms of AUM, let's say an HDFC, small cap, or the SBI funds or ICICI Pru, where the AUM size is going to be much larger. And I think the assumption that we are working with is that because of that, you'll probably see higher number of days required to liquidate. Now, this could confuse an investor. Is that a straight line thing saying, don't worry, because it's a big fund, it will take more days to liquidate? Or could there be certain gray areas within that? So help us make sense of the size, along with the days to liquidate. How should we, navigate this?
Yeah, absolutely. I mean, there is a potential case for that. Yes, a larger fund will have, it's not necessarily the case. I mean, we've, I think, seen, say, for instance, numbers from Nippon, which is the largest small cap fund, and it's not completely out of the ballpark as compared to, it's got a much more diversified portfolio and so on and so forth, right? So I think, yes, size could play an impact. And, again, going back to the point, I think investors don't need to really munch too much on this data from the perspective that, oh, this is 5 days and this is 20 days, as long as, there's not someone who's lying at probably 150 days or 100 days. I mean, these are just illustrative numbers, but, the whole idea is that, is there a significant outlier which can potentially be a concern? I think that's also more for the funds boards and the funds management to think about that, do I need to maybe stop or soft close this fund, right? Which a lot of, in fact, asset managers have done. So I think that's the important perspective. And the other one, which, I know we're short on time, but, which is capacity, right? That's the other thing that investors need to think about, or fund managers and boards need to think about, that am I diluting the strategy of the fund if it becomes too large? Which means, if it's a small cap fund, am I buying large caps because for liquidity purposes, or am I buying that because I can't buy enough small caps of the size that I've grown to? Capacity is a conversation that doesn't happen often. I think that's an important perspective to think about going ahead.
Well put. Let's just quickly get in closing comments from our experts. Radhika, are you seeing any redemption pressure in your small and the mid caps? Is today's volatility associated with the results of the stress test that we've seen? And do you expect these results to cause any volatility?
No, we are not seeing any redemption pressure, and we are seeing positive inflows, and our numbers are very liquid and they were already disclosed, so there's no surprise. So that's question one. I think some volatility was because this was an uncertainty factor. So uncertainty is never liked by the market. I'm hoping with the numbers out in public domain, and as everyone has said, I haven't seen anything alarming as yet from across the industry, and hopefully we will not see it. I think with this event out of the window, hopefully the market will be able to move past this event because uncertainty isn't there. There's disclosure.
Swaroop, same question to you. Final thoughts and a message that you'd like to give to investors?
No, I think primarily investors come to a fund manager to all these things, to do all these things for them. They should leave it to the fund manager. The data that has come out is nothing new. It's just a number we put in place. They should rely on the fund manager and their advisor distributor to work on this. As a fund house, we've always been cognizant of this. We closed our main fund, Emerging Blue Chip, now the large and mid cap, in 2016 on such worries of large flows. We've not had a small cap for some of these reasons, not all of these reasons. So fund houses are mostly cognizant. In fact, post-COVID, when the flows were very high, we'd gone out and reduced our brokerage to reduce our flows and make good these liquidity issues. So fund houses take cognizance of these issues and are running a fiduciary responsibility to managing your money. Similarly, the investors should realize when they are allocated or over-allocated. People who are nervous at this point of time would be more over-allocated than looking at these numbers. So get your asset allocation in place and don't over-allocate is my submission.
Okay, fair enough. Quick last question. Bala, any redemptions at Aditya Birla Sun Life, and what are you expecting of the next couple of sessions till this settles?
I don't see any major redemptions to come in. Definitely somebody who over-allocated to a smaller mid-cap chasing the return, probably they will now stop chasing the return and start looking at allocation of the portfolios between large mid-cap and other segment of the market. But I must also mention that market always wants some reason for it to correct. So it so happened that the stress test compulsion that has come from SEBI is coinciding with the market fall. One should always remember that whatever we have seen a significant rise has to find its reason for it to correct, so that the long run one is able to get a better experience. So I come back to the same point from investors' point of view. Don't get too much worried. Don't do too much of analysis. It will only become a paralysis from your investment decision making point of view. Just consider this: any investment that you make, that I'm investing for 3 to 5 years, not for short term benefit by chasing return.
Okay, we're going to
don't do too much analysis because it will become paralysis.
I think we're going to leave
the conversation. It's a good Friday thought as well, I think.
Thank you very much, everyone, for joining in with your thoughts and perspective. We need to slip into a very short break on that note. We'll come back with more on the markets.